The RBI norms and restructuring are finally out. We've been talking about it all morning. Uh, is that, with this, the norms, at least the framework being set, there is that interest on interest case in the courts later this week. One wonders whether we are coming to a point where, this huge underperformance rather of financials will start to correct itself, or, it gets even more entrenched. How should one think about it?
Yeah, hi, good morning. See, financials offer the highest margin of safety post-sharp correction, provided there is access to capital and quality of book is secured. We do assume as normalcy in business comes back, the collection efficiency of many of the NBFCs and banking sector in general should gradually improve. But at this stage, would rather prefer, secured lending companies, whether it's housing finance with low exposure to builder loan, obviously, or microfinance companies being unsecured are at risk. But given that their target market is rural lending or agriculture, which are an essential category, the opportunities exist in microfinance space as well. But overall, Prashant, to be honest, the financial services sector may go through a volatile phase in the short term. Challenges do exist in the near term related to moratorium, asset quality, and growth. The fundraising exercise has been resorted to by many NBFCs in the recent past to shore up their capital in this tough environment. And we'll have a better handle on the credit cost once the moratorium period is over, and whether borrowers make payments or not for a few months post the moratorium period. So overall, we have to be extremely selective or cautious to invest in this sector. And we have seen in the recent past, many of the banks and NBFCs have made large provisions in the first quarter results in anticipation of increase in credit costs due to the ongoing COVID pandemic, despite lower slippages. So the provision coverage of banks has increased sharply over the past few quarters as they have created provisions in the large corporate loan book and retail book. So while the judgment on interest waiver and KV Kamath report only highlights the issues and stress which some of the banks and NBFCs are ongoing in the current environment.
Okay, Dhiraj, if you were to construct a portfolio equity, just purely equities, what weight would you assign to financials in that?
We'll have to be underweight at this point of time, clearly, because financials traditionally have more than 20% or 25% close to kind of weightage across many of the indices. And obviously that is corrected because financials have underperformed in the current environment. In some cases, rightfully so. In some cases, it has been kind of an overreaction, and that's why we need to be selective. But broadly speaking, our preference will be in the portfolio towards many other businesses, where the predictability is there, cash flow capability is there, and we don't have to run the risk of uncertainty on the delinquencies on the loan book. So we have invested in companies which are in the consumer sector, whether it's food processing, beverages, personal care, or agriculture related companies, because of the strong Kharif season, expectation of benefits on MSP price increases. Besides specialty chemicals, pharma, and metals. These are a preference sector at this point of time.
Dhiraj, morning. This is Rima here. If you have to construct your portfolio, just to take the point forward from Prashant, the problem is that the COVID-proof sectors are already richly valued. The ones where you can see direct value are the ones directly impacted by COVID, like travel, tourism, hotel stocks, etc. Would you start, betting on them bit by bit, considering that the business sentiment seems to improve week after week, month after month, despite COVID cases rising? So is it time to start looking at these value stocks?
So yes, one has to be still selective. For example, autos was reeling under the pressure of COVID, but suddenly we are seeing traction in personal mobility like two-wheelers and cars, which can recover with pent-up demand and preference to avoid public transport. So this was a COVID avoid sector for some time back. And now suddenly we believe that this will become a preferred sector. We are already seeing traction because of online car purchase inquiries from potential buyers are up by almost 15 to 18% versus the February month as per Google data. So this desire to own personal mode of transport is an early indicator for expected improvement in passenger volumes going forward. Rural demand will also drive auto sales because of good monsoon, which has been uniform across states and due to better kharif sowing. But I would be hesitant to buy completely into the non-COVID proof sectors, because we believe that it will still take some time before we see normalcy or early signs of normalcy coming back. So whether it is tourism, cinema multiplexes, for example, I mean, they were not facing disruption from OTT platforms pre-COVID period as well. So that is one area where it's a big avoid for us. And I don't think the occupancy levels will come back for many of the multiplexes businesses, at least for some time. The others are obviously commercial vehicles will take some time within autos. Real estate sector, we still believe will get significantly impacted in the current COVID environment, despite the stamp duty reduction, which has been initiated by the Maharashtra government. But still many things need to be done, whether it is in terms of GST pass on benefits, etc. So some of these sectors will take long time to come back, and we don't have to preempt many of these sectors to just buy because they are considerable value.
Any sectors where you think the valuations or the stock run-up has gone ahead of the fundamentals, where you would recommend lightening up of your position and exposure? Any stocks or sectors that you would like to enlighten our viewers on?
Well, we generally believe in structural, sustainable, long-term businesses. So whether in some cases we may believe pharma sector may get optically richly valued from the current year's or next year's earnings. Our belief is that if one is taking a 2 to 3 or a 5-year view, many of the pharma companies, despite the run-up, will continue to do well, especially in the select chronic therapies, complex generics, and API space. Because obviously there will be a partial shift from China. There is pricing improvement and lower raw material costs. In some commodity chemical cases, to answer your question in specific, I think prices may have run ahead of time and the margins may not necessarily be sustainable. So one has to be cautious on those companies which are commodity-based chemicals, not the specialty chemicals, because that's the space we like a lot. But the commodity chemicals where suddenly you saw supply disruption in the first quarter and the margin improvement happening on account of price increases may not be sustained. So one has to be selective on those names.